Welcome to Pipeline Trading. In today's video, the purpose is to give you a quick, basic understanding of several powerful trading strategies. You'll get a clear overview of how each one works, so you can see which strategies spark your interest and decide if they're worth a deeper dive to see if they're the right fit for your style. We'll cover Fibonacci retracements to spot reversals, breakout patterns to catch momentum, momentum candles for timing entries, take profit levels, support and resistance, and risk management rules that keep you consistent. Let's jump straight in. The first strategy we're going to look at is Fibonacci retracements. And essentially, this is a tool that displays horizontal lines based on the Fibonacci numbers. These lines can then be used as key support and resistance levels. To use the Fibonacci retracement tool, you first start by identifying a swing low and a swing high on a chart. Then drag the tool from the swing low to the swing high. Next, wait for the price to pull back to one of these levels. Ideally the 0.382 Fibonacci level, because this is the most common level where price tends to reverse. If price touches that level, that could be a good buy entry. Keep in mind that price could also reverse from other Fibonacci levels, so combine it with other confirmation signals for a better entry. The second strategy we're going to look at is breakout patterns. Breakout occurs when price makes a sudden and significant movement in one direction, usually after a period of consolidation. For example, here we can see the price consolidating and then moving sharply downward. This is called a breakout. Breakout patterns can help traders identify when a trend is about to resume. Some common breakout patterns include triangles, rectangles, and wedges. The third strategy we're going to look at is reversal patterns. Reversal patterns occur when price moves in the opposite direction of the current trend, forming a countertrend. Specific patterns can be identified on a chart, helping traders predict reversals before they happen. Most notable reversal patterns include double tops and bottoms, triple tops and bottoms, head and shoulders, and cups and handles. The fourth strategy we're going to look at is the Elliott wave. The Elliott wave principle is a theory that was developed by Ralph Nelson Elliott in the 1930s. It suggests that markets tend to move in a series of 5 waves before reversing and forming another set of waves in the opposite direction. By understanding the Elliott wave sequence, traders can predict where price is heading. In a chart, we label each point of the waves as 1, 2, 3, 4, 5, and then a BC. There are specific rules to ensure a movement is considered a valid Elliott wave. 1. Wave 2 cannot be longer than wave 1 and usually pulls back to the 0.618 Fibonacci level. 2. Wave 3 must be the longest wave among waves 1, 3, and 5. 3. Wave 4 must remain above the peak of wave 1 and usually pulls back to the 0.38 to Fibonacci level. Here's an example of the Elliott wave in action. In this chart, the price resembles a possible 1, 2, 3 Elliott wave. Based on the theory, wave 4 often pulls back to the 0.38 to Fibonacci level before continuing upward, which can be used as a potential buy entry. Strategy number 5 is fair value gaps. A fair value gap occurs when a candle forms a significant gap due to an imbalance of buying or selling. To find a fair value gap, identify a candle with a large body. Then draw a rectangle over the gap between the previous candle's wick and the next candle's wick. This level often acts as a magnet where price may revisit before continuing its movement. Strategy number 6 is candlestick patterns. Candlestick patterns are one of the oldest and most popular methods of analyzing charts. Traders use candlestick patterns to analyze future price movements by observing specific candlestick shapes. Some of the most notable candlestick patterns include engulfing patterns, which signals strong momentum in the direction of the engulfing candle. A hammer and shooting star patterns, which indicate rejection shown by a long wick on one side. Doji patterns, which signal market indecision. Strategy number 7 is Fibonacci. The Fibonacci indicator can help traders by reducing market noise and making price action easier to interpret. A green Fibonacci candle signals an uptrend, while a red candle signals a downtrend. The size of the candle's body indicates trend strength. The larger the candle, the stronger the trend. Keep in mind that Fibonacci only acts as an indicator and does not display the real market price. The 8th strategy we're going to look at is moon phases. Moon phase trading is a trading approach that uses the lunar cycle to determine when to trade. The theory behind moon phase trading is that the moon's gravitational pull affects the tides and also affects the behavior of humans, which could impact their financial decisions. Specific moon phases are thought to favor certain trends. A new moon often signals bullish markets, while a full moon often signals bearish markets. Today, it's mostly used as a confirmation tool. The ninth strategy we're going to look at is Renko. Renko charts are an alternative to traditional candlestick charts. Unlike candlestick charts, which form a new candle based on time, a Renko block forms based on price movement. For example, a block could form for every 1% change in price. A green block signals an uptrend, and a red block signals a downtrend. Keep in mind that Renko charts act as indicators and do not display the real market price. The 10th strategy we're going to look at is harmonic patterns. Harmonic patterns are advanced price patterns that follow specific shapes based on Fibonacci numbers. Traders use these patterns to predict future price movements. For example, a bullish bat pattern forms when price makes a series of 4 movements shaped like the letter M, labeled X, A, B, C, and D, with each point following specific Fibonacci ratios. When these guidelines match real price movements, traders can take positions based on the pattern. Notable harmonic patterns include the butterfly, bat, and crab. Strategy number 11 is support and resistance. Support and resistance are key horizontal levels where price has previously bounced and may bounce again. Support is below the price and is a potential buy zone. Resistance is above the price and is a potential sell zone. Strategy number 12 is dynamic support and resistance. Dynamic support and resistance is similar to support and resistance. But instead of using fixed horizontal lines, it uses indicators like moving averages to define key levels. This allows the support and resistance levels to change as the market moves. The 13th strategy we're going to look at is trend lines. Trend lines are diagonal key levels formed during a trend. Upward trend lines indicate bullish trends. Downward trend lines indicate bearish trends. Price retracing to a trend line can signal potential entry opportunities. The 14th strategy we're going to look at is Gann angles. Gann angles are lines drawn at specific angles to identify key levels and trend strength. Price moving along steep angles indicates a strong trend. Shallow angles indicate a weak trend. To apply, lock the price-to-bar ratio, identify swing highs and lows, draw a vertical line at the start of the range, measure 45, and place the Gann fan at that angle. The 15th strategy we're going to look at is momentum indicators. Momentum indicators measure the direction and strength of a trend and are most effective in trending markets. Some examples include MACD, which can signal bullish momentum with an upward crossover, and bearish momentum with a downward crossover. Moving averages, which show price relative to an average and can indicate bullish conditions when price is above the average and bearish conditions when price is below the average. Parabolic SAR, which can show bullish momentum with dots below price and bearish momentum with dots above price. Supertrend, which uses a TR and price to signal bullish momentum with green signals and bearish momentum with red signals. The 16th strategy we're going to look at is oscillators. Oscillators are indicators that show relative strength and are best used in choppy or sideways markets. Some examples include RSI, which can suggest an upside reversal when the price is below the 30 line, and an overbought condition when the price is above the 70 line. Stochastic, which uses random numbers to generate crossovers that can signal reversals. Lines above the 80 line suggest an overbought condition, and lines below the 20 line suggest an oversold condition. The 17th strategy we're going to look at is divergences. Divergences occur when an indicator shows the opposite signal of price movement, often signaling a trend reversal. They can appear in various indicators such as MACD, RSI, or stochastic. For example, price makes higher highs, while the MACD shows lower highs, signaling a potential bearish reversal. Strategy number 18 is volume indicators. Volume indicators measure the amount of buying and selling activity in the market. Some examples include price volume, which displays the volume of each candle, helping traders spot periods of high interest or low liquidity. VWAP, which shows price relative to total volume and can be used as a dynamic support or resistance. Volume profiles, which treat horizontal volume bars as key levels and can help identify areas of high volume and potential support or resistance. The 19th strategy we're going to look at is supply and demand. It's also referred to as order blocks. These are zones where significant price movements have occurred. If price moves significantly upwards from a level, it is considered a demand zone, and if price moves significantly downwards from a level, it is considered a supply zone. It's just like support and resistance. These zones can be treated as key levels for potential entry positions. The 20th strategy we're going to look at is market structure. Market structure is when trader analyzes the behavior, condition, and flow of the market. An uptrend structure is characterized by price forming higher highs and higher lows, while a downtrend structure is characterized by price forming lower highs and lower lows. Break of structure, it is when price breaks the previous price. Peak during a trend, for example, if the price forms a higher highs and higher lows, this break of the previous highs is called break of structure. Change of character, it occurs when price breaks the previous structure during a trend, often signaling a reversal from that current trend. For example, if the price is forming higher highs and higher lows, then it breaks the previous lows, forming lower lows. This is called a change of character. If this video added value to your trading journey, please like and subscribe. It only takes a second, but really helps the channel grow. Drop your thoughts or any strategies I may have missed in the comments. Don't forget to explore my other videos for more tips and market insights. Thanks for watching, and God bless you.